Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today I will once again like to discuss cryptocurrencies and what's their place in a diversified portfolio. We already have an article, it's 1.5 years old, but all of that's written in that article, it's still in place today and nothing has changed. What is the main outcome of the article is that diversified portfolio, when you have a lot of the assets, it doesn't make sense to have more like 5 to maximally 10% of the cryptocurrencies strategically. That's the strategic asset allocation. But what about the tactical asset allocation? There are people who are not ready to hold cryptocurrencies strategically, so without any change, and divide the portfolio into multiple parts and give one of them to cryptocurrencies and just hodl them. They are ready to take the portfolio and when the time is right, strategically hold cryptocurrencies for a few days or a few weeks or something like that. So if you want to do that, you need cryptocurrency trading strategies. We have a lot of them in our database, and we have a new article. In this one, we were doing the analysis and we were looking for a way how to incorporate one simple trend following crypto strategy into the diversified portfolio.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
So what we picked is 10-day high Bitcoin strategy, which is a strategy that we are using very often, and we like it because it's profitable and it makes fundamental sense and also the theoretical sense. So how does it work is that at the end of each day, we check the Bitcoin's closing price over the last 10 days. And if today's price exceeds all prices in this window, it's the new 10-day high. And in this case, we enter the long position and we check every day. So every day, if we are doing the new highs in the Bitcoin price, we are holding the portfolio. And if at the end of the day, it's not new high, we sell the Bitcoin. So we are holding the Bitcoin only when it's making new highs. We obtain the data from January 2018 until the May 2025. Why January 2018? We do not consider the prices of the Bitcoin or any Bitcoin related asset class or cryptocurrency asset class relevant prior to 2018. The reason for that is because in 2018 the Bitcoin was served mainly by some offshore exchanges, so it was hard to get exposure to the Bitcoin. Also, Bitcoin was not open for the public institutions, so if you were a fund, it was not very easy for you to trade Bitcoin. There was no regulation in place, etc., etc. It changed in 2018 because the Bitcoin futures were introduced, especially on CME and CBOT exchanges. So in this date you could start to trade Bitcoin futures. So firstly you had regulation in place and you could get an exposure. So we are using the January 2018 as a starting date of our analysis, and we are using the BITO ETF for testing because it's a strategy that holds the futures. So the ETF was launched in 2021. So we have data from the futures itself from 2018 until 2021. From 2021 we have the ETF data, so we can combine those data together to have data for our analysis. Of course, in spring 2024, new spot ETFs appeared, such as IBIT, FBTC, GBTC, etc. So now it's easy to access the spot Bitcoin market. However, for our historical analysis, we use the futures and futures ETF because we have a longer historical window. But it doesn't matter whether you use the future ETFs or whether you use the spot Bitcoin price as a trading instrument. The result of the analysis is plus or minus the same. And then we use another ETFs. GLD tracks the price of gold, EF holds the US Treasuries, and SPI mirrors the S&P 500 index. So that's like multi-asset setup. Okay, firstly, for the analysis, we need to build the benchmark. So we run the Markowitz on the whole window, and the Markowitz gave us the results that optimal portfolio is 64% in gold and 35% in SPI. If we include the BITO, we have optimal portfolio that's roughly 60% gold, 40% SPI, 10% BITO. So once again, it doesn't make sense to hold more than 10% in cryptocurrencies, even when you do the in-sample optimization. It really doesn't make sense from the risk to return point of view. But this is in-sample analysis, of course, and know what the future will hold. And it's definitely not possible that in the future it will make sense to hold over the 60% of the assets in gold or something like that. So there is another benchmark, which is, significantly simpler, and it's simpler 60% of the equities and 40% the bonds. So 60-40 growth allocation, which is the benchmark for most of the asset allocation strategies for the last 50 years. This is the second benchmark. And we will compare ways how to include our systematic strategy into diversified portfolio to have the better performance than the benchmarks itself. So the first benchmark, which is in sample, optimal portfolio with a big allocation to gold, and the second benchmark, which is the 60/40. How to get there? So what we decided is simple. So we will use the information about the Bitcoin trade to define the risk on and the risk off periods. So in a risk on period, it's a period when the Bitcoin price is making new highs. In this case, it makes sense to have the tactical allocation to cryptocurrencies. In a risk off setting, when the Bitcoin is not making new highs, it doesn't make sense to have the allocation to equity, so it's better to hold the other portfolio. Here is the performance of the strategy itself. It has respectable performance, over 20%, small volatility, respectable Sharpe ratio. So let's move on. What can happen if we take our 60/40 SPI EF portfolio and we will treat this portfolio as a risk off portfolio? So this is the default portfolio you would like to move when the Bitcoin is not making new highs. And if the Bitcoin is making new high, we want to relocate 10% of the total weight to buy ATO. So we want to reduce the SPI and EF positions, and we would like to have the other different allocations. So 55% SPI, 36% IF, and 10% buy ATO. So we are basically switching between the risk on and risk off portfolio. In a risk on portfolio, we have tactical weight in a Bitcoin. In a risk off portfolio, we just simply hold the average allocation. Here are the equity curves, and here we have a benchmark performance. So the benchmark performance for SPI and IF 60/40 is around 8%. With the Sharpe ratio 0.71. If we use the 10-day high signal strategy, so if we alternate between risk on and risk off portfolio, we can increase the performance of the portfolio by around 2%. A negligible increase in the volatility, so significantly higher Sharpe ratio. That's cool. So I mean, what does it mean is that it makes sense to include Bitcoin tactically in the portfolio. When we ran the Markowitz, we saw that it's not the best portfolio to have just the bonds and equity, so it makes sense to add also the gold. Now the question is how much gold? The optimization shows that you should have over 60% of your portfolio in gold, which is nonsense for the next 10 years or I don't know 7 years or something like that. So it will definitely not happen again that the gold will have the same performance. And however, what does it make sense is to include the gold in the portfolio at least a little. So for that case, let's imagine that our risk off portfolio is 55% equities, 36% of the fixed income, and we will allocate 10% to the gold because we understand that gold as a real asset has advantages in the portfolio. Yeah, there are people who would advocate for higher allocation into the gold. I mean, feel free to change the allocation to the higher, but I mean, I would feel comfortable with this broad portfolio, 54, 46, and 10% to gold. So this is the risk off. And if you have the risk on, so once again, we will take the 10% from the equity and bond for fixed income part, and we will put that into a Bitcoin tactically. Once again, we are alternating between the risk on and risk off portfolio, and let's check out the numbers. So here we have the benchmark. The benchmark has a better performance than just 60/40 benchmark. If we alternate between two portfolios, so with using the 10-day high signal, we can see once again that we can increase the performance by over 2% with a negligible increase in the volatility. So it means we have a higher Sharpe ratio. Sharpe ratio runs in this case 0.95. So we have significantly better Sharpe ratio than just the benchmark 60/40, which is 0.71. And we did this by including the gold and having Bitcoin as a tactical overlay. Let's move on. So we have a third iteration, and the third iteration we will try to beat the benchmark itself, and we will try to beat the harder benchmark, and it's the optimal Markowitz in sample portfolio, which I mean shows that in the past it made sense to have 70% in gold and only 40% equities, and I mean absolutely no fixed income portfolio. This is very hard benchmark to beat, but we will try that by including tactical asset allocation to Bitcoin. So we will build the risk off portfolio, 40% equities, 70% gold, and risk on portfolio in which we move 20% from the gold and equities into the Bitcoin itself. And we will alternate between these two portfolios and using the 10-day high signal. What is the result? Here we have a result. So the benchmark performance has a Sharpe ratio of 1.10. I mean, if you remember, here we have a benchmark performance, Markowitz optimization without the BITO, which is 1.10. When we have the Markowitz optimization with BITO, so I mean including the Bitcoin, the best possible optimal portfolio over the last 7 years in sample, we have a Sharpe ratio 0.27. Now, what will happen if we add tactical overlay. So we are not holding the Bitcoin strategically, we are alternating between those two portfolios. So let's move on. So we have a benchmark, and 10-day high signal has a better Sharpe ratio than even the in-sample optimization run by Markowitz. Even when you believe it makes sense to have the more gold, less equities, it is better to have the tactical allocation to cryptocurrencies than the strategic allocation to cryptocurrencies. So it's better to have the tactical strategy that's guiding how much money you should invest into cryptocurrencies than, having the cryptocurrencies strategically in the HODL, fashion in your portfolio. So this is the main outcome of the analysis. Keep in mind, it makes sense to have the cryptocurrencies in the portfolio. No, it doesn't make sense to have a lot of cryptocurrencies, something like, 30% or 50%, because when you have the other risky assets, it's too much. The cryptocurrencies are too risky. It optimally makes sense to have 5 to 10%, but it's even better when you do not have the cryptocurrencies strategically, but you just have them in a portfolio tactically. And what does it mean tactically? To use tactical asset allocation, any trading strategy that moves in and out of the cryptocurrencies and doesn't hold cryptocurrencies all the time. Why it is so? Yeah, cryptocurrencies offer high performance, but they offer higher risk, and that risk is not very good for your portfolio. So it's better to have the tactical strategy that offsets some of the risk, and your portfolio will be better. So this is the main conclusion of our video and of our article. If you want the whole article, all of the calculations, how we come up to the conclusion, you can visit our blog, read the article. If you would like to find some interesting trading strategies that you can use to tactically move in and out of the cryptocurrencies, you can visit our screener. We have 60 or 70 of them in our database. And if you want to learn more about the quant trading or algorithmic trading or finance itself, visit our blog and our page, and give us the like, of course, and visit our YouTube. So thank you very much, and I hope that we will see each other in the next video. Thank you.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.